Good afternoon and welcome to our quarterly town hall. It is now 3:01 on the Pacific time zone, 6:01 on the East Coast. So hopefully we have people joining us from across the spectrum of time zones in the US. After all, we do have clients in 30 states, and we're excited for all those who have joined us. If you have any questions, need anything, we have plenty of support. You can always email us if you're having problems getting logged in. And the only reason I say that is because we ourselves are in the middle of getting everybody logged in after a couple of technical difficulties on the way in, which I suspect are possibly self-imposed by us. We do this frequently, but we're not perfect at it. So I see a good amount of attendees here. And so that means that something good is happening. It's not seven of us here at the Wealth Stewards by ourselves. So we're excited to have all of you join us and hear what we have to say today. It's been an amazing quarter. Lots of changes, both internally and externally. And we have some great stuff to cover today. So let me start off and reintroduce myself for those of you who may or may not know. My name is Jeff Breese, one of the managing partners of the firm. And we're so glad to have you here again today. We've got quite a host of representation from the Wealth Stewards and our expanding team. And so I'll moderate today and take you through everything. A couple of reminders. There is a chat feature, the ability to raise your hands, which you may not see again with technical difficulties, but there is a Q&A. So the Q&A is intended for our clients in attendance to ask questions, and I will monitor those and answer them live. If there's any question that is perhaps unable to be resolved here, we'll get back to you on it. And if we get compressed for time, because we don't like to make these things too long, we'll get back to you on those answers. So for our guests in attendance, the Q&A panel should be accessible to you, and we'll monitor those. And off we go. It is my pleasure, if we can move the slide forward. Again, whoever's doing that, love it. Again, we're like a smooth operation now. Here's our agenda for today. Obviously, I've already introduced myself in our opening remarks. It has been a remarkable 90-ish days since we last spoke to you, so we're excited to cover what we can. I'll talk about a couple of firm updates at the Wealth Stewards here in a minute and introduce a couple people. Brent will then follow with a brief update of the recap of Q1 of 2026 and talk about a couple of things as we look forward into 2026 and what has been an unbelievable set of developments that we've all talked about internally and with many of you, and we'll try and give some clarity around those. Cyrus will come on board and talk about some planning pitfalls, which are some common mistakes that we see made that we would love not to be made, and hopefully we're not making them with you. But even maybe you can share some of those mistakes with others that you speak with, and if we can help solve them, we'd love to do so. Kayla is going to come on board and talk about a couple tax updates and give us some information there. And then we'll flip to the Q&A, try and answer some questions as best as we can, and hopefully get out of here before 45 past the hour. So if we advance the slide, yeah, perfect timing. I love it. Without having to do it. Notice my hands are free, so this is amazing. I do want to make the update. Many of you may have seen this, but effective early March, we opened what we call TWS East, which is the Wealth Stewards East Coast office, which is located in Massachusetts. We are fortunate enough that that office is now staffed by one full-time advisor who has joined us, and that would be Amanda Adams, who's about to come on board and introduce ourselves. And we're also fortunate enough to be able to hire an administrative assistant to help Amanda in that office. Grace has been on board with us since Amanda joined just about 2 months ago. And so they're off and running and serving clients in that neighborhood. Some of you know, I grew up there. Brent grew up on the East Coast and worked on the East Coast. And again, with our national footprint, we found it a fitting opportunity not only for Amanda to join us, but to build an office presence there that we're really excited about. So I'll shut up and allow Amanda to come on board and say a few words, introduce herself, and officially unveil herself to the Wealth Stewards and our national presence via the town hall call. So Amanda, come on board and please give a little introduction.
All right.
We saw you for like one brief second and it was glorious. So come on back to us.
Can you hear me? I
Yeah.
promise you, this is not my first time on Zoom. I don't know why the video is not unclicking. There we go. Okay, all right. Everyone can see and hear me. Good afternoon, everyone. Greetings from the Massachusetts office. I'm Amanda Adams, your wealth advisor here. And as Jeff said, we officially opened our doors in February. It's been exciting few months as we've welcomed new clients and started to build some real momentum. As Jeff mentioned, we have Grace Driscoll here, and we're continuing to help clients get fully integrated with the goal that our clients feel understood, informed, and in control every step of the way. So it's been very energizing to see all of this take shape over just the past few months. And just wanted to say that I'm really delighted to be a part of the Wealth Stewards as we share the same values and goals, and to collectively be a part of a very deep bench. So my hope for today is that clients tuning in for the very first time will enjoy meeting this extended team and see real value in these town halls going forward, and will join us again in the future. So thank you so much for the introduction. I look forward to meeting so many of you, and I will turn it over.
Thanks, Amanda. The process of bringing Amanda on board started to take shape in January of 2025. And it wasn't without a lot of careful consideration by Amanda. She was in a very good environment in her predecessor firm, great client roster. She is a true professional, has her CFP designation, does business the right way. On behalf of Brent, myself, our entire team who have gotten to know Amanda for the last now 16 months, we couldn't be more delighted to have somebody of her caliber join. So our ask would be is that if you have anybody that is further extended from the reaches of the West Coast that might need the level of care and concern and professionalism that you've seen from us demonstrated out here, the East Coast office is open for business, has capacity, and has a grade A advisor and support system there as well. So if anybody has ever thought about friends or relatives in other parts of the country and might want to make an introduction, we would be eternally grateful, as we always are, for that. And moving on to another introduction, and one closer to home here in Arizona, to our 2.0 office, as we call it. That would be Casey Kleiner, who has joined us recently. And I think Casey is maybe prepared. There he is. Okay. Do we have a camera that works this time? Hey, look at that.
You turned on.
Technology is an amazing. Casey, why don't you introduce everybody? Tell us a little bit about yourself, what you're doing here, and maybe a fun fact. I don't know. Just throw something in there.
Will do. I think I can do that. As Jeff mentioned, Casey Kleiner, newly joining the TWS Scottsdale location as a relationship manager. A Phoenix native, born and raised here in the area, so I am very fortunate and excited to serve families here, but beyond our Arizona borders. So I'm a certified financial planner, and looking forward to continuing to have these planning conversations with families here and abroad. Personally, as far as that fun fact goes, my beautiful wife and I are expecting our very first addition to the family. We're expecting our first baby here this fall. So beyond the craziness of making sure we're prepared as possible, if that even is possible, we try to find the nearest beach or visit our family cabin up here in northeastern Arizona as often as possible.
Awesome. Well, Casey, welcome as well. We're glad to have you. Casey comes to us from prior work with Cyrus. And so he comes highly endorsed by Cyrus, who came highly endorsed by Ryan, who we seem to trust with a lot of these robust decisions, and rightfully so. They haven't served us wrong yet. So Casey, thanks for the intro. Amanda, thanks for the intro. And fortunately, that covers the new people for the quarter outside of Grace, who is in Massachusetts and as a senior in college and a join as her first step into the professional ranks, probably is doing something more fun as she prepares to graduate than hang out on a town hall with us. I know we all think this is tremendously fun. To a 21-year-old, maybe things are a little bit different, but you all will meet Grace at some point, I think, hopefully on a future call or in your interactions with us. So Some really exciting growth at the firm. One thing I want to point out before we transition on to the next port about growth at the firm, we are keenly aware that there is a commitment that has been made to all of you as clients and friends along the journey, whether it be over the last 2 years since we came to Concurrent and made the move out of Raymond James, or for Brent and myself and Ryan for what was decades of work together at Raymond James. The growth is not in sacrifice of the existing infrastructure, the service model, we are layering these things on so we can grow responsibly, take care of the same people in the manner that we always have, if not better, and then amplify the growth with these new advisors and new staff to make the Wealth Stewards even better. So I hope none of you see this growth as anything other than the ability to serve more people in more meaningful way, because that's exactly how we look at it. So enough with people and growth. Let's now transition over to my good friend, my partner, Mr. Brent Mekosh, give us a snapshot of the prior quarter and a little bit of insight to what we think might be coming ahead. Brent, take it away.
Thank you, Jeff. Appreciate it. You can go ahead to the next slide, Chris. So when we began last year, we had three major themes that really dominated for us. The first was AI playbook. We know that AI is impacting so many different things in our lives and also in the markets and in the economy. The second was navigating valuation. And the third one initially felt like it was sort of a throwaway thing. We need that third bullet point, which was noise resistance. And it turns out that that one probably is the most important one that we've had so far this quarter, because 2026 so far has been loud. It's been geopolitically loud. It's been politically loud. It's been very loud from a market narrative standpoint. And I think that this year so far has shown really the importance of having a process and staying with that process instead of just reacting to the headlines. Those of us that have stayed with the process, at least so far during this whole thing, have been rewarded by it. But we're going to come back to that. Let's go ahead to the next slide. So this is a really good slide. I don't expect anybody to be able to read this, but basically what you're looking at is a series of massively disruptive events that have happened back all the way to the Gulf War. So we have the Gulf War is represented here. September 11th is represented here. The trade war with the US and China is here. Brexit's in here. Russia, Ukraine is in here. And then, of course, we have Hamas and Israel, which happened a few years back. And of course, we have the Iran conflict. So that tiny little red line on the left-hand side is the Iran conflict. And this is going through the end of the quarter at the end of March. Now, you have seen that red line sort of pop back up since then because we've had a meaningful rally in the markets. But what I want to point out with this is these have all been massively disruptive events by any measure. I mean, COVID, hugely impact across so many areas of our lives. September 11th, again, a huge impact. But they don't look the same, but they all kind of rhyme, where you get an initial downdraft in the markets, you get a lot of fear, you get a lot of uncertainty, you get a stabilization point, and then in every single case, we've seen the markets rebound into new highs. And when you look at this in terms of what's happened with Iran, now there could be a lot more to come, but it's followed that so far this quarter, and I think that we're probably going to continue to see this play out over time. The only one that really, if you look 400 days in the future, because that's basically what you're looking at here, the only one that really stayed a lot lower for a longer period of time was September 11th. And that's largely because not only do we have a massive, disruption to our way of life, and what is also in the wake of the dot-com crash. So there was a lot of things economically happening at that time as well. But as much as these news items definitely impact us, they tend to work themselves through. It's not a comment about how serious the nature of what's happening over in the Middle East is, but this is an environment where we want to maintain our consistency. We want to stick with the plan and just watch as things unfold, because in every other historical case, things have unfolded that have led to new highs, at least in the equity markets. Let's go ahead to the next slide. Now, this is very interesting. So this is software being under pressure. Now, I'm talking about the AI playbook that we discussed right here. AI is causing a lot of big changes in the overall economy and the markets, and it's also driving returns in certain areas. And in other areas, it's where it's gotten a little bit uncomfortable. What you're seeing here is that dark blue line on the very top there. That is software price earnings. Software companies have historically been priced at a 50% premium relative to the S&P 500 because it was a really good place to put some money. It had fantastic growth rates. But what we learned here, and this has spillover effects into other areas of the economy, is what happens when AI can replace or enhance traditional software, particularly the revenue models around them. and solve a lot of problems that software historically did faster, cheaper, and at scale, and brings all the pricing power of these companies into question. So that's kind of the foundation. This slide also, you could talk about private credit as well. We do have some clients that are placed in private credit. We're very cautious and very diligent about which specific funds that we use. But you might have seen on the news some issues with private credit. It's because many of these funds are overexposed, quite frankly, to software companies. It was a really easy place to go and lend some money. And those that didn't do the proper due diligence have had some impacts at that. But I think what this chart really shows is that AI is not necessarily going to impact areas of the market in places that we think initially. It's going to have impacts all throughout the entire market. As an adjunct to this, I'd also say that we've seen small cap stocks particularly do really, really well this year. And that's because now you're bringing these massive these systems in place that can allow companies with historically a lot less resources to scale their operations up significantly without necessarily having a new hire, without spending a ton of money on software. They can do a lot of things in-house. So where it's hurting one area of the market, the traditional software providers, it's actually helping other broader areas of the market. Let's go ahead to the next slide. Now, this is just to give you an idea where we're at so far this year. All the numbers look better as of the close today. This is as of March 31st. But if you're looking at what worked going through the end of March, we talked a lot about valuation when we spoke last quarter and why we were very intentionally were underweight, I would say, the market for sure, and I would say a lot of our peers, particularly in U.S. large cap growth. That ties back into to software, ties back into the S&P 500. We also talked about valuation concentration, where you had about 10 big companies in the S&P 500 that essentially accounted for about 45% of the value of the S&P. I think the term that we used back then is just owning the S&P 500 is kind of akin in this market to owning a very high conviction, long only fund. What we saw in the first quarter is many of the stocks and many of the different names that were under pressure, they were a lot of these big growth companies. And you saw the S&P 500 was the worst performing of the major asset classes. Now it's turned positive since this chart was done, but as of March 31st, it was down about 4.2%. What did you see then in other areas of the market? Well, the answer is not really much. You look at fixed income, municipal bonds, TIPS, U.S. core bond was actually completely unchanged. High yield municipals up a tick, high yield corporates down a tick. That ties back into that software play. U.S. long dated bonds down a tick. But what really worked? Well, first of all, real estate worked. Real assets worked, up about 6.7%. Commodities really worked, up about 24%. And overall in the hedge fund world was up about 3% or so. This is meaningful to us at the Wealth Stewards because by most measures, I would say that we're overweight alternative asset classes. Every single one of our models, regardless of how much money is invested, has an alternative asset sleeve that's roughly 15% of the account value. So what we're basically operating with our portfolios is something that looks a lot more akin to a hedge fund than a traditional 60/40 US portfolio. So this year, in fact, if you look at the absolute worst of the Iran shock, what we found is our alt sleeve was actually still positive, up about 3% for the year, and the alt sleeve is up about 8% right now, which has really stabilized the portfolios in the downside. And in a world where US stocks now are up a couple percent, pretty much all of our portfolios are outperforming that because we've got overexposure in international markets, which have significantly outperformed their US counterparts. And the alternative sleeve is doing in this environment exactly what it was designed to do. Let's go ahead to that next slide. Now, whenever I did a variation of this slide last quarter where I basically overlaid money supply with the S&P 500, and we got a lot of feedback on that. And I want to show this again in a slightly different context because I think that it is really important. Whenever you get these big news cycles, these big events like we've just outlined, it's very natural to have the desire to pull some more money off the table, not be invested or not invest new money until the crisis passes. And there's going to be another one down the road. We know that. But here's why that's always not the best idea. You need to have cash on hand to meet any emergency needs that you might have. You need to have cash on hand in the bank to make yourself sleep good and feel good at night. And that number is not the same for everybody. It really depends on what their needs are, what their personalities are. There's a lot of factors involved in that. But here's one thing that we do know. So the line that's descending from the upper left down to the lower right, this is the purchasing power of your dollars going back to 2007. Every year, those dollars are losing purchasing value. The one that's moving up and to the right, this is money supply. This is the amount of money that is out there in the system. Federal Reserve continues to print money. Federal government continues to spend money that has to be financed somehow. The money supply pretty consistently has been rising over this period of time. Like anything, you create more of something, there's less scarcity, it becomes less valuable. We had one notable exception to this consistently rising increase in money supply. We had it rising very gradually from 2008 to 2020, this massive spike up in 2020 during COVID. If you recall, in 2022, it was a pretty tough year for the markets. S&P 500 equities under pressure, fixed income, bonds even under pressure as rates were rising. Money supply was also shrinking, and that's why I think that this chart is so critical because we are back at all-time records. There's never been more money in circulation than there is today. And so, of course, have the cash on hand that you need. Have those short-term treasuries and things like that you need to sleep well at night, and also meet any big spending obligations that you might have, in the next year or two. There's no question that you need to have that. But the thing about cash deposits, the thing about money is on a day-to-day basis, it is probably the safest asset you can own. When you go out beyond 5 years or so, and you go further than that, it looks even worse. It is the easiest way to get poor over time. And so I think it's very important to realize that having those dollars sitting in the bank, not out there working for you in the long term, tends to be a pretty bad decision when it comes to increasing your family's wealth. Now, with that in mind, I'm going to turn this over to Cyrus, who's going to talk about some planning issues. And Cyrus, I'll send it to you.
Thank you, Brent. Just to almost double down on the last slide, we wanted to target 3 different common planning pitfalls that we see. And if you can go to the next slide, it's almost the same thing here. But what you can see is one of the biggest pitfalls we see, or financial mistakes, if you will, is just an overexposure to cash. Oftentimes, people hold on to cash because it feels safe. They don't want to lose their money. They're worried that the market's going to go down. They won't be able to access their money right when they need it. Murphy's Law. These are all normal thoughts and feelings. But as we sometimes have these conversations, we peel back layers of the onion. We find that there really isn't a plan for why there's so much cash on hand, which can lead to an unnecessarily large portion of the balance sheet that just simply isn't working for you. As you can see here, the money that you thought was safe and that you didn't want losing actually is losing to inflation almost every single year. $10 in the 1980s is worth about $3 today. If you look at the price of homes, food, gas, all up significantly, even in the last 5 years. Even though the stock market has had its fair share of bumps along the road, you'd still have been far better off keeping your money invested than in cash. In fact, putting your money in the market at the worst possible time historically has still offered better returns than cash, as long as you have time on your side. You might be thinking, Cyrus, you don't know my track record. Literally, as soon as I put money in, it goes down. Like the market's waiting for me to put money in to go down. That's why I'm holding cash. Well, what I would tell you is, even if you had the worst luck and you invested your money at the very top in 2021, right before the market was down 19% in 2022, and you held through today, you'd still average more than 10% a year. If you invested your money at the very top in 2007, right before the market had an over 50% drawdown, you'd still have returned over 10% a year. If you bought at the worst possible time. Hoarding cash because you're worried about the next black swan event could cost you in the long run, especially with money that you don't need anytime soon. If you can go to the next slide, Chris. That said, I'm not telling you take all of your cash and invest it. But it's important to think about your liquidity and plan accordingly. The rule of thumb is to keep cash aside for larger purchases or ongoing needs for the next 3 to 6 months. Simply put, short term, the goal is don't lose. Long term, the goal is to grow. Here's an illustration that shows the percentage of the time that the stock market, notably the S&P 500, the US stock market, is up over rolling periods. Probably no surprise, the longer you stay invested, the more you're putting the odds in your favor to generate positive returns. Now, if your plan looks good, you don't need a lot of risk to accomplish your goals. We're not telling you put your money in the stock market anyway. You have to be able to sleep at night, but there's oftentimes a better solution than just hoarding cash. So that's the first pitfall. If you can go to the next slide, I think this is a little timely. Pitfall number 2, ignoring taxes until April. Tax season came and just barely went. April is when you report your taxes, but it shouldn't be when you plan for them. CPAs are called tax preparers because they prepare. They don't plan. Some of you might do tax planning with your CPA throughout the year, but for others, for many, it's important to think about taxes throughout the year. And what we want to show are 3 common ways or areas that it's important to really plan for taxes before April. The first is Roth conversions. You might, or just, IRA distributions. You might be in a low tax bracket. You might be really happy about paying a low tax bill, but there could be an opportunity for you to actually take more income in a year in those really low brackets to prevent yourself from having to take income in higher brackets later. That can only be done in the calendar year. You have until April to make a contribution to an IRA, but you only have until the end of a calendar year to make a distribution for it to count for that tax year. Secondly, gain or loss harvesting. Sometimes, good markets, you need money, you sell, there's a capital gain. You have company stock that comes due, a business sale, there's a capital gain event. It's important to look at where there's an opportunity to offset some of that gain with a taxable loss in your portfolio. There's strategies in place to try and enhance those losses, but just in general, it's important to look through the accounts to see if there's an opportunity to take losses. In fact, waiting from December 30th to sell something at a big gain, waiting until January 2nd the following year gives so much more flexibility to prepare, to try to offset that gain with losses. It just increases your flexibility. So that's another area that we see sometimes things not just in the portfolio, but outside of the portfolio will happen that can create these big taxable events. And then thirdly is cash flow planning. One of those big cash needs that I just referenced could be a big tax bill that's looming. And understanding what that tax bill might look like could help not have to sell from your portfolio to cover that tax bill at the worst possible time. I'm not forecasting anything, but man, the last couple of Marches have not been great in the market. We had Liberation Day in March, April last year that prompted the pullback. We had obviously the geopolitical news that prompted the pullback this year. Fortunately, at this point, we've recovered this year, but if you had to sell during that pullback to cover taxes, that could hurt. So making sure that you understand and are aware of what your tax payment would be and having a plan to generate the cash for it without scrambling at the last minute. And then pitfall number 3, no coordination between advisors. Yes, you are looking at a kitchen, a beautiful kitchen that's flooded. That's not a mistake. You might be wondering, why are we looking at this? What does this have to do with anything? I want to give a really simple analogy to help kind of paint this picture. A homeowner has water damage in the house. They contact a carpenter. The carpenter comes in, they look at the warped cabinets, the damaged drywall, and they say, you need new wood, you need new trims. I'm going to repair this wall for you. They bring in a plumber. The plumber looks under the sink and says, no, the real issue that we need to fix is the leaking pipe. This could become just an issue all over again. If you don't fix that first, the drywall and the cabinets are going to keep getting damaged. Next, an electrician comes in. They notice the moisture near the outlets and the wiring. And they say, no, the biggest risk here is this could become an electrical hazard if the water reaches the wiring. We need to look at the wiring and make sure that it's okay. Each one is right, but each one sees the problem through the lens of their own trade. The point of the story is specialists often give good advice, but only from their own angle. If no one is coordinating the entire picture, you could fix the symptoms, you could miss the cause, or create an entirely new problem altogether. When the electrician, the plumber, and the carpenter all see the same problem differently, the need is for someone who understands how the whole house works. A general contractor. The same thing holds true for finances. If your CPA, your attorney, and your advisor are all working in silos, all that right advice could still lead to the wrong outcomes. So especially if you're making bigger financial decisions, it's important to allow your investment professionals and your financial professionals to coordinate with each other, work together, and provide you with the best possible outcome. And
Great, Cyrus. Yeah, no, thank you. That was excellent. It makes me wonder if I left the dishwasher running this morning, so I'm a little bit nervous, but great visual, I think, for those of you to understand exactly why we see such importance in particularly that third pitfall. So any questions related to those pitfalls, either now or in follow-up, you can use the Q&A here or certainly check with any one of us. And now it's time to turn over to Kayla and allow Kayla to take over and run with a couple of updates from her standpoint. Kayla?
Thanks, Jeff. Chris, if you can go to the next slide, please. Everyone's favorite subject, especially on the heels of some of you writing a check to our favorite institution. These are some changes that have already happened or that are happening this year that we've already had discussions around with clients. Some of these items might be actionable to you, so we thought it would be best to bring it up now. The first change that we want to talk about is the new senior deduction. This is in addition to the standard deduction. If you are 65 or older, you may be eligible for this starting in 2025. So there are income limits that it's based on your modified adjusted gross income, which of course your CPA should have those figures. Essentially, if you file single and that number falls between 75 to 175, you'll only be eligible for a partial deduction. If you file joint and that number falls between 150 to 250, you'll only be eligible for a partial deduction. But it's worth, if you're unsure if it applied to you, go back and look at your tax return if you already filed, or check with your CPA, hey, does this apply to me or not? The second change, which is effective in 2026, is what they are calling the super catch-up contribution for your employer-sponsored plan. Now, a lot of you are probably aware in the past and still currently, if you are 50 or older, they have what's called a catch-up contribution, which this year is $8,000 that you can put in to your employer-sponsored plan on top of the, this year, $24,500. New to this year is if you fall between the ages of 60 and 63, you can now contribute an additional $11,250 to your employer-sponsored plan. Now, if you're 63 now, but you still have a birthday coming up in the summertime or fall, you would not be eligible for it. You're still eligible for the $8,000 contribution, just not for the super catch-up. You have to be 60 to 63 on December 31st of this year. Okay. Now, also related to catch-ups, someone tally how many times I'm saying catch-up. I hope you guys aren't getting hungry. They're calling this the Rothification of catch-up contributions, meaning if you're doing those catch-up contributions, most likely they have been going into a pre-tax bucket within your 401k. Starting in 2026, they now have to be directed into an after-tax or Roth portion of your employer-sponsored plan. And we don't want to assume that your plan is automatically redirecting these contributions for you. That's great if they are, but it's easier to get ahead of it now. It's worth signing into your portal, calling your admin. Just double check if you are doing catch-ups that they're going into the after-tax bucket. It's a lot easier to fix now rather than springtime 2027 comes and you find out that they were still going into a pre-tax bucket and now you have to adjust everything before you file. So it's worth signing in,
to your portal, calling your admin, make sure those are going to an after-tax or a Roth bucket within your plan. And also, too, one favor, if you've never had a Roth portion in your plan, and now because of this Rothification rule, you're having to start contributing to that, let us know. Drop us an email, give us a quick call. We always like to know when clients of ours have a Roth 401k. We incorporate it into your financial plan that we do on our side. It's just good information for us to know. And that's all I had for the super fun tax updates. I will pass it back to our closer.
Thanks, Kayla. It's funny, you were talking about phrases, and I'm looking at this, and I'm thinking about the evolution in my career of retirement plans and contributions, and I wrote it down. We started out with maxing out, right? So I maxed out, but no, that's not enough, because after you max out, you can do a catch up. And catch up sounds like, well, that's got to be the last thing we do. No. Now we've got the super catch up on top of the catch up on top of the maxing out. And so I'm stating it here. I am going to run for Congress, and I am going to be the author of the super duper catch up, which is going to be even better and more money. So vote for Jeff. That's going to be where we're going to land, and we're going to have so much super duper catch upping. You guys are going to love it. Thank you, Congress and the IRS, for making everything so simple and easy for all of us as taxpayers and funders of your pensions. That might have been a little frustration, because I too am suffering from the day after tax season's closed. So the formal part of the meeting is over. My gripe is out. My lame attempt at humor related to catch-ups is over, which means it can only be time for Q&A. To date, we have 2 questions, which is fine. Again, it's our aspiration to get out of here in less than 45 minutes. The first one I will leave as a toss-up for anybody who wants to take it. And it gets back, Brent, to your comments earlier about software being in a sell-off mode and valuations. And the question is specific to the software industry, but perhaps we can answer it in a broader context. And the question is this: when segments like software, or perhaps others, sell off significantly, do we look for opportunities? And I guess the follow-up question would be, if so, how do we handle the potential for sell-offs in different parts of portfolios to take advantage of those opportunities? So I'll leave that one up, and if nobody comes online, I'll answer it. But I think Brent might have an answer by virtue of him coming off mute and showing his.
It's a great question. I think some of this is so new, what AI is doing in some of these different industries, that you got to wait and see a little bit. I think the question is, how sticky is their service? How robust is it? How easy is it to replace by some of these tools? Because you can run into the situation where just because something's cheap, you think it's going to get it's not going to get even cheaper. I remember back when Obama took office, there was a really concerted effort to get coal, for example, out of the power grid in the United States. And a lot of these coal mining stocks got cheaper and cheaper and cheaper, and they got cheaper and cheaper and cheaper until they were worth zero. So you have to be really cautious of that. I do think that one of the things that we do in here, as opposed to trying to pick individual stocks, what we do is we're looking at whether we're dealing in private markets, which we're doing more and more of, or we're in the publicly traded stuff where we're using funds. We're looking towards managers that are closer on the ground, that quite frankly are probably in a better position to answer some of those questions as it relates from company to company.
Yeah, and I'd layer an answer on there across the complex of the Wealth Stewards and the money we manage on behalf of you all. We have a pulse on a regular weekly basis on how the different segments of our portfolio is doing. So as Brent alluded to earlier, we're aware on a regular basis and monitoring across the complex, when alternatives are outperforming, when U.S. and non-U.S. stocks are playing off of each other. And so, part of our internal workings and system for managing portfolios is not only do we monitor it, but we have software platforms and systems in place for you all that help us exploit when your portfolios have come out of their tolerance for drift in all these different categories. And that could be a masterclass in itself in numerous hours of taking you all through that. I think the real thing is, one of the beautiful things about software evolution over the last decade, let's call it, is the ability for us not to have to monitor that at your individual account level and to be able to do that across the complex in real time. And so those things are happening every day. One, via the software that manages your portfolio at the Wealth Stewards, through the Wealth Stewards and Fidelity. And then, as Brent said, that is the exact exercise we spend a lot of time with and have over the past couple of years since we came out of the Raymond James complex, and building a partnership to select managers who do that work all day long. And if anybody wants to get into any specific details about which manager might perhaps take advantage of software dislocation. And the only other thing I was thinking about earlier is, as it relates to this question or the comments Cyrus was making about, cash and reserves. And we talked about that a lot in context to cash versus the market. Remember that it's not a binary situation. It's not, you keep your money under the mattress or in a bank account, or it's in the S&P 500. These portfolios that we construct and the complexity to which we've built them on your behalf, although it looks simple, hopefully on your side, takes advantage of risk across the spectrum of assets. And we work on that all day long. And I tell you, the thing I think I've communicated to my client base that I'm most proud of over the last 16 months, is the risk adjusted performance that our clients have experienced, right? So it's not just the return, it's how much risk is associated with the return. And we can very easily, with the tools that we have at hand, show you that down to your individual level, even down to an account in a segment level within accounts. And so anybody who has any follow-up with those types of things individually, please reach out to your primary advisor or team, and we'll certainly help with that. The other question that came on board comes from the slide showing the events in the recovery. And curious if anybody on the team happens to know the 9/11 drawdown was not back to break even by the end of that, like 400 days. Can anybody speak to, similarly to other parts, how long it took to recover from 9/11 if you were an investor, and has that ever paid off? Does anybody have any kind of either anecdotal or evidence-based sort of stuff to talk about? Well, in a 9/11 scenario, which was the worst of those outcomes, did you still win by being a long-term investor? Anybody want to speak to that?
Yeah, I'll speak to that. And again, that was a somewhat unique environment because not only did you have a massive disruption that occurred in downtown Manhattan, which I was about 4 blocks away when that occurred, but you had the United States now put on an entirely different trajectory that I would argue we're still following today. And that was also then in the wake of the dot-com crash, which you had in 99 into 2000. So, and to give you an idea, a lot of the questions that we're getting today, particularly around tech, and tech has gotten a lot cheaper in Q1, tech's been a good place to be the last couple of years. It's so far this year has probably been the worst place to be if you were solely invested just in technology. But from a pure valuation standpoint, even at the peaks that you had last year in technology stocks and large cap growth, what was happening in 99 to 2000 was probably an order of magnitude by two, meaning it was probably twice as expensive by a lot of measurements as it was now. Many of these companies that were driving returns back then, they weren't even real companies. They didn't have real products. And they had very little revenue. They certainly weren't making money. And you compare and contrast that, where you can argue Microsoft perhaps is a little bit too expensive, or Nvidia is expensive, or it's cheap. You can make those arguments, but you can't argue that they're real companies. And you can't argue that they have a real product or a real service. So it's a very different world. But back to your point, Jeff, I think, and I'm going off memory here, but I recall because I was back in New York at that time. You had obviously big disruption right after 9/11. Market went south pretty hard. You had a rally a little bit toward the end of the year. I think the Dow was trading like 11,000 or so, and it traded down, I want to say, below 7,000 during the summer of 2002. And I think you were in early 2003 or something, but I'm going off memory, so you could be very wrong. Somebody's going to fact check me. But I think 2003, you're kind of back to being whole at that point. What was different back then, for sure, is you were also coming from an interest rate environment where maybe you were at 6, 7% or so. And that's when the Fed started getting crazy about just cutting rates. So even in that, where you had 2001, 2002 were both negative years back to back for the S&P, which doesn't happen that much. At that point, a balanced portfolio still did pretty well because you're making it up on the fixed income side because rates were dramatically dropping. So you were getting not only paid at higher than current market rates, but the value of your bonds and the value of your fixed income went up pretty dramatically as well. So it was
Yeah, I'll never. Yeah. Go, oh, sorry. Go ahead. Finish.
yeah. So, in the picture, so it wasn't as bad as just the S&P or the Dow suggested it was for the average investor. It wasn't great, but it wasn't carnage for 2001 and 2 if they were actually running a balanced portfolio. And I would argue that our ability to run better portfolios today is significantly better because what you have had in the last 20 years, a lot of these alternative asset classes that we spend a lot of time talking about in the front end have been radically democratized. I mean, we have market neutral funds in there. We're selling volatility in our alt sleeve. There's strategies in our alternative sleeve through a regular old mutual fund that were not accessible to all but absolutely the wealthiest investors or institutional investors 25 years ago. So
Great.
that's where it looks a little different.
Reminds me of the quote, necessity is the mother of all invention. And so I think what came out of a stressful time that Brent and I were both in back then, albeit much younger versions of ourselves, that statement rings true. It's now officially 46 past the hour. We like to keep these to 45 minutes. We started 1 minute late. And so we appreciate you all bearing with us in that 60 seconds of what must have just been desperation waiting for this content. But that is the conclusion of today's presentation for you all. We're again grateful for not only your joining us, your confidence in us, your willingness to allow us to make decisions to expand our team and grow our business while we try and serve you even better than we have in the past. We take none of that lightly. So on behalf of the entire team at the Wealth Stewards, our expanded family that we've added, that we introduced, we're so grateful for your time, and we'll see you next quarter. Have a great night.